This is the Friday, July 26, 2019 version of the Market Plus segment. Joining us is Sue Martin once again. Welcome back, Sue.
Thank you, Delaney.
Sue, I had to cut you off there right at the end of the program talking about the lean hog market. I want to let you finish that thought process.
Well, when I look at the hog market and you look at China, you know, just the agattache today to China came out with some numbers. And of course, we hear all sorts of numbers about their production and pork production and numbers of lost sows and what have you. And they were talking about that pork production dropped 21% this year, or numbers dropped 21% the first half. And they're thinking we'll see another 10% drop here, maybe in 2010 or 2020, I should say. And, you know, usage or consumption maybe declines 9%. But I think one thing that we have to keep in mind is that their supplies of pork are now very tight. As they went towards July 1st, all warehouses were going to have to be tested, and they knew it. So they were really pushing the product onto the market. That is running pretty tight and thin. So now the prices of pork have escalated sharply. And in the meantime, because hog prices have gone up and the product has gone up, there might be some incentive for these producers to maybe take another gander at trying to produce hogs. It might be a long shot, but they're going to probably try. In the meantime, demand for other meats, beef, poultry, is pretty good and strong. So the fact that China allowed some companies to be able to come and buy pork duty-free, I think is interesting. And I think we'll see that demand. And of course, keeping in mind that Smithfield is owned by Shinwei. But we also have to keep in mind that in early 2020, the Chinese Lunar New Year, and pork is one of the major things that they like to have for their celebrations. So I think the demand for pork is going to be ramped up here in the last half of this year. So a correction back. How much will it be? Might only be $5, might not be quite that. It might kill more time, just like cattle are doing. But the key will be if it comes up and starts to take the highs out, now we're getting ready to move on, because we have come back 50% of our market break. And I have to admit, the hog market looks to me, when I look at a weekly chart, there's a beautiful up channel in this market. So it looks to me like we've got some room to move higher with time.
Okay, do we have room to move higher in the feeder cattle market?
Well, the feeders have been a little more marking time, but I think so. The one thing about the feeder market, there's two things going on at play. One's a negative, where producers, or not producers, but feeders, are a little apprehensive this year because they had such a horrible winter last year and spring. But then on the flip side, you look at these wheat pastures, and they're going to be in great shape come fall. And so you're going to have good wheat pastures to put cattle out on. So I'm wondering if that won't help support the demand. It's the price of corn. What happens to the price of corn? You know, we're looking at the situation. Sean Hackett was on last week, and Sean put out a commentary this week itemizing the 4 prerequisites that have to be for you to have an early killing freeze. And all 4 of those are in place this year. You know, the 18.6 lunar module, the El Nino weakening or gone, and maybe moving towards, we might be in a Matakai, but moving towards a La Nina. Having the grand solar minima, which is one that you don't normally have, that comes about every 200 years, and then another solar situation that's a cycle within. So there are reasons to believe that we are very similar. I don't think we had all 4 in 1974, but that's a year I have maybe even talked about on the show before that I think we're very similar to this year for late planting. I looked at the years of 1993, 1995, and 1974. I didn't get a chance to look at, I think it was 1965, but there are other years that we were late planted and what have you, but that we had some of this set up. But these are the 3 years that really do compare with this year, and all of those did tend to put highs in July. This year put its high in June, and those 3 years, the longest it was between the high of July and the low in September was 2 of them put their low in September and around the first 9 days, maybe the first 7. So there was like 26, and I think the longest was 42. So trading days. So if you look at that, and I look at corn, and we've been having a tendency to put a low in around the first week of each month. And that would be around maybe the 4th, 5th, 6th, whatever. Well, we have timing coming up here this next week on the 1st and 2nd of August, and it's our cycle windows. But we also note that this next week is 360 weeks from the 2012 high. And that's, according to GAN, a full circle. So I think this next week's very important. I think that we close lower for the month, which means December corn closes under 432. And then we come down and we push a little bit lower. I think we could come back down to about 414, 410. If the market wanted to be dirty and nasty, because right now there doesn't seem to be any real concerns about pollination. But it's still, we've got another, 2 weeks at least, and Michigan would be later. I think that we need to keep in mind that the pollination does account for 90% of the yield, but we are so late this year that if we were to be hit with an early frost freeze, we're going to decimate the bean crop in the areas where it hits, and we would probably stop the growth of the corn wherever it's at that time. Won't dry down, be just very lightweight, what have you. Now the key is, when the weather sources I'm using are talking about, and they've been talking, we'd turn cool and wet in August, but more for the western half of the Corn Belt. The east is supposed to possibly enjoy a longer Indian summer, which would be ideal for them. That could give a bearish connotation to the market because everybody's all about what happened in the eastern side. But then all of a sudden, we've talked about southern part of the U.S. and how those crops aren't going to be the cat's meow this year like they were last year to hold up the rest. And then you have the eastern Corn Belt that's in trouble and very late and needs everything to go right. But the western Corn Belt is where the better crops are. Nebraska, Iowa, kind of variable, Minnesota, and what have you. Now you hit the better part with an early frost freeze, and I'm sorry, we're going to have to ration this corn, even though regardless we do have feed usage down. Corn starts to move up, well, all of a sudden wheat's going to have to kind of compete against it.
Okay. Sue, when we're looking at all of these factors that are impacting this year's crop and potentially the corn rally, we've got a good question here from Bradley in Upland, Nebraska. He said there is a great deal of focus on acreage and final yield. While little attention is being paid to the lower crush that we've seen for corn and beans, the imports of corn into the southeast and lower exports, do you see it possible that we could have a corn carryout of 2 billion plus and beans 1 billion plus at this time?
No, I don't. And that's even with the understanding that we are 720 million bushels behind in our feed usage for corn. The reason we're pulling it in from South America in the south and southeast is because they just can't get it. An Ohio cattle feeder was bidding huge over the board for corn and couldn't get it. It's the corn, I just don't think it's there. It's what's really making me start to wonder. You'll have your outliers, your people that will be hanging on some, but I think the majority of it is not there.
Sue, let me ask you this then. We've got a question from Paul in Columbus, Wisconsin. He said, planted acre number, does it even matter at this point?
We have talked about that number and talked about it. When the gentleman from the statistician or actuarial gentleman was lecturing this week and talked about 15 to 20 million possible prevent plant acres. Well, we have to keep one thing in mind. That is encompassing many commodities. Corn may be the biggest, soybeans, and then you've got some cotton, rice, and other crops that's going to encompass. However, the trade, I think, is pretty much priced in maybe a 7 to 8 million number, mainly because that's probably how we got up to that 473 anyway on December corn. Now we're going to have to see something bigger than that. We won't know a yield or an idea of a yield until we get into September, and that's justifiable. So I think what is more important is we have to have everything go just right to get this crop home and to get it home decently. And I'm just afraid that we're looking at a year where Mother Nature has not been kind and
She
continues
has
to
other
be.
plans for us.
Yes, she has been a little bit of a nasty person or lady, you know. But I think that we have to keep this in mind. And yes, demand is key and big. But you look at France, one of the bigger producers of corn over in Western Europe, 109, 108 degree temperatures, record high temperatures. And while there is talk that next week they might start to cool down and catch some showers, boy, they've been hurt because that heat really encompassed a large portion of Western Europe.
All right, Sue Martin, thank you so much.
Thank you.
Join us again next week when we explore how the U.S. leather industry is searching for new markets, and Darren Newsom will join us at the Market to Market table. Until then, thanks for watching, listening, or reading. I'm Delaney Howell. Have a great week.